How can an insurance company earning 5% on their invested assets can afford to credit you 8% or more on indexed universal life? You can't believe how many financial advisors do not understand what I'm about to teach you. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for north of 5 decades, helping thousands of Americans optimize assets and minimize taxes, prepare for a comfortable retirement so they will not outlive their money. My favorite financial instrument, without question, is a properly structured, max-funded, indexed universal life. And a lot of times people will say, well, how can an insurance company that's only earning 5% on their investments afford to pay you 8%? And I go, okay, let me explain it to you. And hopefully when you understand this, you'll see why it's my favorite financial vehicle for retirement and a lot of other financial goals, okay? So an insurance company has billions and even trillions of dollars of assets. They are the backbone of America, the backbone of the world. That's why during the Great Depression, even though some real estate dropped 80% in value and banks closed, 40% never reopened their doors again. Not one single legal reserve insurance company went under in the Great Depression. And the same thing is true of 2008 when 400 banks went under. 900 more were on the watch list on the brink of going under. Not one single legal reserve insurance company in 2008 went under, okay? Now, it's because of where they have their invested assets. So if they have, $1 trillion invested in, AAA and AA bonds or mortgages on skyscrapers and shopping malls, by the way, they're very conservative. They don't loan money on some skyscraper or shopping mall at 80 or 90% loan to value, like regular mortgage companies do. They only loan maybe 50% loan to value. So if they ever have to foreclose, they usually make money. They don't lose money, okay? And so that's why they've weathered times like the Great Depression. Well, over the last 30 years, depending upon the interest rate environment, because interest rates are relative. If you don't understand what that means, when interest rates are high for borrowing, they're high for earning. When they're low for borrowing, they're low for earning, okay? And so the interest that they have earned has been between 4 to 16%. Now, they probably average between 6 and 8%, but during the last few years, the last 10 years or so, we've been in a low interest rate environment. So most of these insurance companies are earning 5 or 6%. Let's just say 5%. Now, they're in business to make a profit. They usually need about 1% for them. But the net general account portfolio yield would be 4% in this example. They're earning 5, they're keeping 1% to cover their overhead, and they will pay you 4% if you just want to play it safe with your IUL. So let me illustrate this with an example of $1 million of cash value in an index universal life policy. If you had $1 million in there and you felt bearish about America, you thought we were headed for a recession, you can just hunker down and play it safe and settle for that 4%. So at the end of the year, you would be credited $40,000 on your million. That's tax-free. And now your account value would be $1,040,000. No brainer, okay? But if you feel bullish about America, you think that the economy will grow or the market will go up more than 4%, you can choose to link some or all of that million to an index or indexes, both are correct, of your choice, okay? So we'll use the S&P 500, which is a common index. You link to the S&P 500. What that means is if the S&P 500 at the beginning of your 1-year period, and a 1-year period can be March to March, it could be July to July or whatever, okay? If it was 5,000 and 1 year later it was 5,500, that's a 10% increase in the S&P. And so the insurance company would credit you 10% on your million, $100,000. How can they afford to do that? It's because you are not telling the insurance company to take one dime of your $1 million and invest it in the market, in the S&P. Your million has to stay safe in the insurance company, earning 4. Well, how can they afford to pay you 10 if they're only earning 4? Because you're relinquishing the 4% interest. You're saying, hey, keep my million safe, but you can take my 4% interest on my million, the $40,000, and do whatever you need to do to have the wherewithal to credit me whatever the increase is in the index or indices that I choose, okay? So when the S&P goes up here, 40,000 of options will grow to 100 grand, okay? People say, how? Well, you need to understand options. They're big boys and girls. They know what they're doing. They wouldn't offer it if they didn't know that they would predictably have the wherewithal to pay you that, okay? And so sometimes they'll have a cap. If the options expire worthless at the end of the year because the S&P went down, you don't lose your million, okay? You just relinquished earning, and you didn't make anything, but you didn't lose, okay? And so there's usually a floor. Zero is your hero. If the market goes down, you don't make anything, but you don't lose, okay? But they might cap you, like during the Great Recession. The caps were 16 and 17%. So there's 1 year, like 2009, people were credited 16% tax-free in 2009 after not earning anything in 2008, but they didn't lose any money in 2008. And so most 10-year periods since the Great Depression, you'll have 7 gain years compared to 3 loss years. In the Great Recession, there were 5 loss years. So in that case, there would have been 5 years you would have earned 0, okay? But you didn't lose. The other 5 years, you would have earned whatever the S&P did up to a cap, and it only capped out 2 of those 5 years, once at 17% and the other time at 16%. But your average during the worst decade since the Great Depression would have been 7.23% in the worst 10-year period since the Great Depression. 7.23%. If you understand rule of 72 math, you divide 7.23 into 72, your money doubled in that 10-year period. $1 million doubled to $2 million. Even though 5 years, you didn't earn a dime, but you didn't lose, okay? And so your money would have doubled, whereas people who had their money in the S&P, that $1 million would have dropped down to 600,000 twice and didn't even come back to break even at the end of 2010. It took until 2012 to finally be worth $1,046,000. By then, most of our clients had tripled their money. How? Because of rebalancing, okay? So from 2000 to 2010, 5 years, 0, and the high was 17. But our clients, we didn't tell them to just sit there and earn 0 5 of those years. In 2001, after the 9/11 terrorist attacks, they earned 0 that year. But in 2002 and 2003, we just had them move back over and earn 4. It was actually 5% net back then. So they earned 5% instead of 0. Same thing happened. 2007, they didn't make anything, but they didn't lose. In 2008, we moved them back over and they earned 5. Just by having 3 years not earned 0, but earned 5, okay, guess what happened? Rebalance, that's called rebalancing. We have annual reviews with our clients. They were credited 11.17% average, okay? That is gross. They netted over 10% tax-free on their money. And that's why if you do the math, at the end of that 12-year period when most Americans were barely back to break even, most of our clients had $2.5 to $3 million for the million they started with just 10, 12 years earlier. So that's the magic. That's how an insurance company only earning 5 can help you earn 7.23 or even 11, okay? Easily 8. That's like a no-brainer. So if you want to learn more about this, I strongly recommend you study our most recent best-selling book, The Laser Fund. This is actually 2 books in one. This side is about 200 pages, 14 chapters, with all the charts and graphs and explanations if you're a left-brain learner. If you're a right-brain learner and you learn more by stories and examples, you can flip it over to this book, about 100 pages, 12 chapters, with 62 actual client stories of how this works, okay? If you want to use your whole brain, your right brain and your left brain, I would recommend you study the whole book. It will be a game changer. Now, folks, when you go in to claim your free copy, you can buy it on Amazon for $20 plus shipping and handling. And if you do that, thank you. But you can simply go to laserfund.com or click on the link below, and you contribute a nominal amount towards the shipping and handling. I require a little bit of skin in the game. Cover some of the shipping and handling. I'll cover the rest of that, and I'll pay for the book. I will fire out a hard copy to you via priority mail. And while you're in there claiming your free copy, if you'd like to listen and learn or watch and learn, there's those formats available for your investment. You can even schedule an appointment with a top IUL professional that I oversee so that they can do an illustration of how this may work in your particular set of circumstances. You can even schedule to attend a free educational webinar that we do every single week. But this is not about me. This is about you and your brighter future. So understand how you can safely earn rates of return of 8, 9, 10, 11% tax-free and not lose money when the market goes down.